Welcome to Crossroads. The Chinese economy is becoming even less transparent. Now, in what's being deemed a highly unusual move, some Chinese banks are just told to not settle recent purchases of government bonds. And as the market in China is becoming more opaque and, notably less predictable, well, what's happening? Investors are taking their money and they're pulling it out of China in record numbers right now. Now, Bloomberg notes this. They say in a highly unusual move on Friday, regulators told rural banks in China's Jiangxi province not to settle recent purchases of government bonds in order to effectively renege their market obligations. It was the latest in a string of interventions designed to cool a market rally that sent yields to record lows and stoked official concerns that banks have become too exposed to interest rate risk. And notes further in the risk is that meddling by authorities detaches the market from its economic fundamentals and undermines long-term investor confidence. Again, as we've been talking about, state interventionism and the many problems you have from interventionist policies. They're feeling it. And notes as well the government's attempts to intervene in shares and currency trading in recent years, with sometimes chaotic consequences, have deterred international money managers. It notes that in one sign of how deep pessimism toward the country's assets remains, data last week showed that foreigners pulled a record amount of money from China in the second quarter. It notes as well the saga underscores the dilemma that Beijing is in, the CCP, right? While it has to support the sluggish economy by keeping borrowing costs low, it's trying to make sure that money is not so cheap that a bond bubble is formed, jeopardizing financial stability. And I'll show you in a bit that actually they're kind of facing both of these right now. And note that authorities are mindful of the collapse of Silicon Valley, which piled into its treasuries before rates rose, and have been seeking to limit risks at financial institutions. Now look, given this situation, some companies that were hit really hard in China, like the real estate industry, they were actually turning to bonds because they're kind of being sold at a discount right now. And some of them were buying up bonds at a 90% discount using unknown sources of money. They don't even know where the money was coming from. And then after they bought up the bonds at a 90% discount, they were canceling their securities. Let me show you. Bloomberg said this July 21st. The source of the money is shrouded in mystery, but a major Chinese real estate developer appears to be trying a novel approach to resolving its debt. It is working with a buyer, unknown, to purchase bonds at deeply discounted prices and then canceling the securities. And it's the move by China Fortune Land Development Co., whose default in 2021 marked the beginnings of the country's property crisis, are the latest twist in a debt debacle that has left more than $140 billion of real estate bonds in default and become a massive drag on the world's second largest economy, China, of course. And it's further in, the developer is attempting to eliminate some of its bonds cheaply and outside of its restructuring agreements via private contracts with bondholders and a third party. So what you're seeing, in other words, is things that aren't too unusual. You do see some things happening like this, maybe not so much on a massive scale like this. But the problem the CCP is facing, again, is it's trying to prevent a bond bubble from forming, and it's trying to keep its currency from kind of fluctuating too much, either into inflation or deflation. And so the CCP right now is facing two very difficult sides of an issue. And of course, it doesn't seem like they can do it that well because they're intervening in such a way where they're kind of doing both of the things they try to not do while trying to fix the other side. Now look, leading up to the CCP's recent crackdown on the bond market was this. The CCP's central bank, they were planning to begin short selling of bonds. And again, this ties into what I just mentioned. They're trying to solve two crises at once, right? But to solve one crisis, you need to exacerbate the other crisis. And they're having really conflicts now between even the banks and the CCP and the businesses and the banks and the businesses. They're all kind of conflicting with each other right now. Bloomberg notes this. July 16th, China's central bank is readying a bold new experiment in global monetary policy, taking a leaf out of the hedge fund playbook and arranging to short sell bonds. Governor Pan Gongsheng's People's Bank of China, one of the main banks in China, right, has been busy lining up hundreds of billions of government bonds it could sell to prevent a bubble forming in the nation's $4 trillion debt market. And it notes that having long eschewed quantitative easing, the PBOC, People's Bank of China, is now set to embrace the unorthodox policy of steering yields by dealing directly in the bond market, but from an unusual direction. It notes where the Federal Reserve in the U.S. and peers bought bonds to push yields down when their economies flatlined. In China, the PBOC is readying to sell them to guide long-term yields higher as a rally extends to record levels. Now, this is where it gets complicated. Despite this, the Chinese Communist Party is facing another problem. Within a few days of all of this happening, right, we're talking, again, when this was taking place, there was also a concern being raised by the CCP's own central news outlets. And the central news outlets in China, that's essentially the mouthpiece of the party itself. If, CCTV or, the Xinhua, for example, make a statement, or some of the other main state-run news outlets make a statement, they can't make those statements without the approval of the CCP. And so the statements will represent the official stance of the Communist Party. Again, there were concerns being raised by one of the CCP's own central news stations, their outlets on this, that institutions buying up China's treasury bonds were shorting the country's economy. And this essentially was the Chinese mouthpiece itself criticizing the Bank of China. Reuters said this July 13th. Financial institutions snapping up Chinese government bonds are basically shorting the Chinese economy. China's central bank-backed financial news reported on Saturday, citing what it said were the views of industry sources and experts. And the report is the latest warning to the country's bond market after the People's Bank of China, the one we just talked about, sounded concerns and introduced plans to sell treasury bonds to cool the bond rally. Again, the CCP's mouthpiece, in response to the PBOC saying they were going to do that, said that that would amount to shorting the Chinese economy. And so the solution is not possible without causing short-term harm for long-term good, right? And that's where they're kind of stuck right now. They don't want to do either, but they're doing a little bit of both, and they're causing harm to both sides. Now they say this, quote, financial institutions frantically snapping up government bonds equals to expecting that interest rates will get lower and lower in the future. Again, the CCP's main paper said. It says they are basically shorting China's yuan, the Chinese currency, and the Chinese economy, increasing the pressure for capital outflows. In other words, one of the things you'll see among a lot of investors is they're expecting interest rates to get lower in China. You pay less interest on loans and everything else, right? And given that situation, a lot of the anticipation, a lot of the moves financially from the banks, from financial institutions, from the investors, it's being done with that expectation. This, from the CCP's own kind of mouthpieces, suggests that they're not going to do it, that they can only do it maybe to such an extent. And given that, they're kind of managing expectations by coming out and saying this. And they're noting that making those types of moves while anticipating something that might not happen is something that damages the Chinese economy and is shorting the yuan, the Chinese currency, and shorting the economy overall, and also increases the pressures, as they say, for capital outflows, meaning it's making people want to get their money out of the country, right? And we're actually seeing that, by the way. Now, on this, the issue with Chinese bond, they're raising this, right? It's raising additional concerns with investors. Not only have the CCP's recent moves created less transparency, to say the least, on a market that was already known for lacking transparency, but it also shows that the regime's bond market itself could be facing serious issues. Financial Times noted this, the very thing they're afraid is going to happen. There is a bubble in the Chinese government bond market, or so at least the People's Bank of China would fervently like to believe. It says a bubble would be worrying risk to financial stability. The existence of such a risk, however, is far more palatable than the plausible alternative, that bond markets are sending out an increasingly dire signal of concern about the prospects of China's economy, the danger of deflation, and the need for a change of course. Notably, after the third plenum, the CCP didn't really introduce a change of course. If you read what the CCP actually said, because they did the third plenum, they had top-level meetings, they actually did release somewhat of a plan. And the plan was essentially mainly focused around service jobs. Almost the entire plan was the CCP was saying they want top-quality restaurants and top-quality cafes and top-quality services for people taking care of the elderly. Well, how do you build that? How do you build that, a service industry, as the main focus of a country's economy, when at the same time you're talking about the failing real estate industry and you're talking about capital outflow in major investment, you're talking about trying to build a high-tech economy as the savior of the entire economic system, but the entire economic plan has nothing to do with any of that. It's about service economy. Hey, build good restaurants, essentially. This is the problem they're having right now, is that for investors, the CCP has not introduced anything that would fix the issues of the biggest concern. And hey, great, build good restaurants, have good services for people. I would say most countries on earth attempt to do that. How do you manufacture that? How do you get people to have good service? How do you create that? Well, you really can't. How do you make a good chef? Well, maybe good training schools and stuff, but they already have that. What's preventing it, of course, is the fact that you can't balance low cost and high quality. You can't have both. And what the CCP is trying to do right now, in every sector, whether it's Shein and Temu or service economies or food or anything like that, is people don't want to spend a lot of money. The upper class is being even ridiculed for flaunting their wealth right now. The push is for the lowest common denominator. And if the push is for that, well, then that's what the market is going to serve. The market will react to what, where the pressure is, essentially. And if they're being pushed, hey, lowest cost, don't flaunt your wealth, everybody's having economic problems, kind of batten down the hatches, what are they going to do? Well, they're going to try to cut costs as much as they can. And what happens when you cut costs as much as you can? Well, then you have the Temu and Shein effect, where you're selling the cheapest goods you possibly can, and they don't meet a lot of the standards in the countries that you're trying to market to, or even among the populaces you're trying to market it to. It puts pressure on the manufacturers. The manufacturers risk going out of business. They cut costs even more. The quality goes down even further. And then the problem that is causing this entire mess gets exacerbated. This is the problem they're facing. Now, on this again, we were talking about the story, it's talking about the problems of deflation and this whole bubble forming. How is the CCP getting out of it? Well, they say this, that back on the note of bonds and capital outflow and the bigger issues they're facing, they say over the past few weeks, the PBOC, People's Bank of China, has been engaged in a strange mirror image of the quantitative easing campaigns conducted by many global central banks. And again, being criticized by the CCP's central mouthpieces for doing this. And also where others tried to push down long-term bond yields to stimulate their economies, the PBOC is battling to hold them up. And so again, it's the issue short-term gain versus long-term gain. And when you're facing a crisis, you can't have both. And they're trying to have both. Now notice that China's 10-year yield dipped briefly below 2.1% last week after sliding all year before PBOC action pushed it back up again. The authorities have gone so far as to name and shame a group of rural banks for buying government bonds. We talked about that in the beginning of this show. And it notes that it's the most unusual sin, like punishing a child for tidying their bedroom. Again, it's schizophrenic policy. One side doesn't align with the other. Now look, meanwhile, as the Chinese economy is struggling to revive itself and banks are trying to find ways to save things using kind of normal means and then being criticized for it, then being pushed to do things that are abnormal, right? As the CCP is facing this, well, look, investors are watching it. And what's happening as investors watch this? Well, they're saying, do I want my money in this country right now when it's not stable, obviously? The investors don't seem to believe the safest bet, right, is to be there, so they're getting their money out of the country. They're moving their money out because for them, that's not that big of a deal. If it looks like it's rallying again, they can put their money right back in. But they don't see that right now. And it's at foreign investors right now, right? They're pulling their money out of China in record numbers. And notably, and this is important, a lot of their money is going to India. And this is important because India is one of the big economic competitors with China, and more money in India means more pressure on the problems causing a lot of these things in China right now. Now, I'll be talking more about this after we get back from a quick break.
Experts agree. One of the best ways to protect against financial uncertainty is to diversify your portfolio. Learn how physical gold and silver can secure your retirement funds from today's economic challenges with a gold IRA from American Hartford Gold. You can safeguard your wealth with no penalties or taxes when you transfer your current qualifying retirement accounts. Call now and our precious metals specialists will send you a free information kit, no cost or obligation. American Hartford Gold, a trusted industry leader with an A+ from the Better Business Bureau, has a 5-star rating from thousands of happy clients. Whether you are getting physical precious metals in a gold IRA or delivered to your doorstep, we offer only the highest quality gold and silver. For your peace of mind, we also offer a no-fee buyback commitment, a low-price guarantee, along with free shipping and free insurance. So don't wait. Call the number on your screen today and secure your financial future.
Welcome back. Something weird is going on with China's economy. Now look, recent moves made by the Chinese Communist Party have made the economy even less transparent. And what's being called a highly unusual move is taking place where Chinese banks were just told by the CCP to not settle recent purchases of government bonds. And as these moves take place and as the Chinese economy is, struggling to survive right now or maybe revive itself, well, investors are wondering if it's stable enough to keep their money there. They don't seem to believe the safest bet is to be there, and so they're getting their money out of the country. And foreign investors are now pulling their money out of China in record numbers. Bloomberg says this: China's direct investment liabilities and its balance of payments dropped almost $15 billion in the April to June period, marking only the second time this figure has turned negative, according to data from the State Administration of Foreign Exchange released Friday. It notes that it was down about $5 billion for the first 6 months. Should the decline continue for the rest of the year, it will be the first annual net outflow, money leaving like this, since at least 1990, when comparable data begins. And notably, in 1990, the Chinese economy was in absolute shambles. Now look at notes. The fall comes despite Beijing's growing efforts to attract and retain foreign investment. They always say this, by the way, hey, things are great, bring your money back in. And it works like a pyramid scheme, right? Money comes back in, the CCP says, hey, look at all the money we have. They lure in new investors, use the money to show returns for old investors, and the system keeps the illusion going. Now with this, right, and notice that they normally try to attract and retain investment. They're doing that right now. And this follows the smallest increase on record last year. And so the statements of the CCP don't align with fiscal reality, in other words. Now, they note the government wants to show it remains open and attractive to foreign businesses in the hope that companies will bring advanced technologies and resist pressure from the United States and elsewhere to decouple from China. And that's complicated because, look, imagine you have a big high-tech business, right? You're like, okay, I'll jump into the Chinese market. Well, what are they developing? They're developing electric vehicles and batteries and solar panels and the steel industry and everything like that. They bring stuff in to work with these industries, right? What happens then if the industry gets sanctioned? What happens if they get hit by tariffs? What happens if the CCP backs Russia, as it is doing right now, in continuing the war against Ukraine or in backing Iran now in the war with Israel? What happens as that situation continues? And what happens when Europe or the United States puts sanctions or tariffs or additional trade measures to prevent these types of things? Well, that means that your huge investment moving manufacturing to China is now useless. It means that now you're caught in the crossfire of an international conflict. It means that you have damaged your brand, even in some cases. Now, would a company want that? Would an investor want that? Something that unstable? Well, no. And that's what we're seeing right now. And that's in addition, notably, to the problems the CCP's economy is having, the failure of the CCP to show an actual plan to fix it, the schizophrenic policies where they're trying to fix the short term by harming the long term and trying to fix the long term by harming the short term. You can't have both. Where they're trying to say high cost, low cost, high quality, and do both, but it doesn't work like that. And even as they're finding that because of some of the sanctions, even the banks in China are having trouble even doing business with their closest partners. The CCP is even having trouble resolving, payments, for example, with Russia because of the sanctions. Now, it notes this, and this is important. Chinese outbound investment, the thing the CCP doesn't want to happen, also hit a record, with firms sending $71 billion overseas in the second quarter, up more than 80% from the $39 billion in the same period last year, when things were also looking bad, notably. Meaning it went from bad to worse in terms of the way investors are viewing China. And as the Chinese firms have been rapidly stepping up investment with money going into projects such as electric vehicles and battery factories, notably both of which are being hit with tariffs right now. Now look, a lot of the investors who are pulling their money out, they've been putting their money into India or other countries in that region. A lot of it's going to India though. And this is important because it signals kind of where they believe growth could happen. And the important part with India is that on the areas of growth, it is one of the biggest competitors. Maybe India doesn't see this, but China does. One of the biggest competitors to the CCP's ambitions as a manufacturing hub and as a high-tech hub. India, to an extent, has already achieved, kind of the high-tech manufacturing base. India, to a large degree, already kind of has that veneer, right? They're already kind of seen like that. And at the very least, they're known to have the potential, especially because of the education and the skill sets they have. Now, this signs that India could get a lot of business also that's leaving China. High-tech industries, manufacturing, not just cheap manufacturing, which is also probably going there, but even advanced manufacturing. Now look, it's also telling the Chinese firms they're still putting their money into areas like electric vehicles and battery factories. But again, this is despite the fact that the industries were suffering from overcapacity. Aside from the trade battles and everything else, right? The CCP, because again, this is the problem of state interventionism. When you direct money to go somewhere, what happens? When you say that you're going to, raise up one industry, what happens? Well, you push down the others. You make the playing field not even. And so certain industries that people might do organically in a healthy market, people don't do them because they're not sustainable. And what do? Well, they put their assets into the one being propped up. What then happens? Well, you have an overproduction of the one being propped up. This always happens when it comes to state interventionism of this sort. And notably, this is what the CCP is now facing. It's a common problem you find in communist countries. So they propped up, notably, EVs and electric vehicles and batteries and things like that is some of the main focuses. Well, tied to that are entire industries. You have rare earth minerals, you have steel, you have other things. All of those industries are by extension suffering from overcapacity as well because they had to overproduce to feed an industry that was overproducing. Now that works as long as you can sell it, but what happens if you can't sell it anymore? Well, you're sitting on huge warehouses full of goods that are rotting and rusting and going bad that nobody wants. So what do? Well, you lower the prices and you dump them on foreign countries. The United States and Europe, they don't want that happening. And so they have been putting trade restrictions on those industries to prevent dumping of excess production onto their markets. And so what happens then? Well, it means that all the investment and all the manufacturing and all the jobs, not even just, again, the surface product, right, the batteries and the EVs, but the entire supply chain that exists to support the manufacturing of that. Everything in that entire chain becomes destabilized. And that's what they're facing right now. Going back to India, because this is really important. With India, notably, again, they're seen not as just a competitor, right? A future superpower against China. They're more realistic. They're saying it's maybe going to take like 75 years to break out of it. And they know that they're probably going to get caught in the, quote unquote, middle income trap. They're a little more realistic in terms of breaking out of the kind of economy they have right now. And realistically, they're not too different from China in a lot of ways. Now, what they don't have is a communist government. What they don't have are these strict schizophrenic policies trying to micromanage everything. What they don't have are the problems the CCP is facing economically or in production or in supply chains or in international conflicts. India is kind of like the Switzerland of Europe. They tend to kind of stay out of conflicts if they can do it. And because of that, they're a much safer area for investors. Now, what happens then if the businesses that used to be in China and the money that used to be in China goes to India instead? Well, it means that investors and manufacturers build up their industries, which represents then a direct competition to China. The other side, too, is India is talking about 75 years long-term growth. The CCP is talking about short-term and long-term simultaneously, both conflicting with each other. But India has something else, which is they don't have the falling birth rate issue China does, or the aging population China does. The CCP is losing its workforce, in other words. And the aging population issue there is going to be a long-term problem for any kind of long-term growth, including the long-term policies they're trying to introduce now to save their economy. Again, the money going to India then is a deep threat to the CCP. The manufacturing going there is a deep threat to the CCP because it means that the future of those industries has moved somewhere else. And notably, as they move somewhere else, if it works, they're going to stay there. In other news, China is still being hit with natural disasters. And even the CCP, they're now noting the serious damage that this is causing to the country's crops, its food supply. I'll be talking more about these natural disasters and what they mean. We'll talk about that only on EpochTV.com. So if you're watching on YouTube, Facebook, X, Rumble, there's a link in the description below. Click on that. You'll get access to the rest of this episode, as well as our whole library of shows and our hard-hitting documentaries on issues that really matter, like the Chinese Communist Party's 100-year plan to defeat the United States. The CCP is one of the biggest threats to America. They're using propaganda, video games, entertainment, movies, culture to subvert and influence the next generation. This unrestricted war against our country is one of the scariest but least understood issues of our time because it's not tangible. It's being done through soft power and ideological subversion. Now, I've spent over a decade investigating the CCP's subversion, and it's such an important issue that I made a documentary called The Final War, which exposes this 100-year plot of the CCP to try to take down America. If you'd like to find out more about what exactly the CCP is plotting against this country, watch The Final War. You can find the link in the description below, and I'll show you all the trailer before we go exclusively to EpochTV.com for the rest of this episode. I'll see you there.
The greatest threat facing the United States is the CCP.
The Epoch Times investigation team had studied the CCP for years, but what we uncovered was yielding evidence beyond our imagination.
With Chairman Mao, with the Prime Minister, our talks have been characterized by frankness.
The Clinton administration said, oh, don't worry about it. This will be a poison pill for China.
China's strategic goal is to make sure that the U.S. has 4 enemies, and one of them must be a terrorist group.
We are giving of our life's blood so that the Chinese Communist Party can survive and thrive.